Anyway, I want to talk to us a little bit today about what is market volatility and what are the 5 things that lead us into a market correction. Before we get started, I just have to give some disclosures that as we talk about these different things today, these are my ideas, my values, my views, and they're just basic information, not for you to act upon and go through and make changes in your portfolio until you sit down with a professional and make sure that it's right fit for you. Whether you meet with us or somebody else, just make sure that you're meeting with somebody before you make those decisions based off of something that you're going to hear in this video. Great. So let's jump into it. So what triggers market volatility? Well, there's really 5 different things that can trigger market volatility. And that starts with maybe profit selling. Okay. Profit selling is when you go through and you buy into a particular stock or a fund, and it has done extremely well, right? We're always taught that we need to buy low and sell high. And so now it has done really, really well. And you decide to sell off and receive some of those profits. Well, you're probably not the only one who's doing that. If that fund has done a really, really good job, you're gonna have a lot of people that are probably doing that exact same thing. And as individuals start to sell off the shares of that holding, it's gonna start to bring the shares of that value down, right? So it's gonna look like maybe the company's starting to do something incorrect, or their holding's doing something incorrect. And that's because of the fact that we've got profit coming off of that holding, making it a little bit weaker. Next is we got corporate earnings. Corporate earnings are when a company has an idea of what they're going to do in production and in dollars over a year's time, and they sometimes go past that. The expectations they exceed their expectations, I should say. And so at that point, they're not wanting to really pay a lot of taxes on that, or maybe have challenges. So they'll take some of those earnings and they'll give it out as dividends to their shareholders. So as they're paying that money out, that really becomes like a liability because they're paying it out. And as they're paying that money out, it is going to bring their share value down. I like to ask this question a lot of times. If you have a large company and they go through and they lay off, let's say 15,000 employees, is that going to cause their stock to go up or go down? Most people will think it's going to cause the stock to go down, and it actually causes the stock to go up. Because see, what happens is that they lay off 15,000 people, they just got rid of all that liability. All of that money that they have to pay out into payroll is now done. And so that means they're going to get to keep a lot more profit, which means that their stock will actually go up in value. Next, we got technical analysis. The technical analysis is when individuals that do a lot of computer work, these are these guys who like and girls that like to pull together a lot of graphs and charts and things that most of us just really don't totally understand. And they try to overlay them on top of each other based off of history to where we are today, and try to see if it's going to give them some type of like maybe a crystal ball reading of what's going to happen in the future. And so they'll go through and make decisions based off of what's happened in the past and how they feel it's going to alter the future. And they'll decide to either pull in or pull out of a different holding based off of their technical information. Now, I'll tell you, I've been doing this for a long time, and I've watched a lot of these groups who really profess that they are great at doing this. And I yet have found any of them that are really, really good at timing the market in and timing the market out. I will say that a lot of them have pretty much got a pretty good handle on how to perfect getting out. It's the getting back in that's really the challenge. And we can kind of relate this a little bit to like weather, right? We turn on the news in the morning and they say there is a 10% chance of rain today. And then we go out and it pours that afternoon. Or we'll have them say there's a 90% chance of rain and we never see a cloud that entire day. It's the technical side of trying to read radar and read weather streams to see what's going to possibly happen in the future. And I'm going to tell you, I don't believe there's anybody on earth that can really truly read and tell us the future. We have a crystal ball in the office that I like to tap on all the time and say, look, my crystal ball is broke. I think most people's crystal balls are broke. And so technical investing is a really difficult way to go, but it does add to a lot of market volatility as these individuals may pull money in or out of different holdings, causing different challenges. Fear is probably the biggest one that we've seen really recently. And that is because I think a lot more people are dealing in their 401ks and they're dealing in investments on their own. And now the rulings have kind of changed that you can kind of move in and out of your 401ks in a much faster pace than it used to be before. A lot of times you can move your money out, but then you had to wait for different enrollment times to be able to put money back in. And so because of that, we're seeing that a lot more people are watching the news and they're getting very fearful of what's happening. And I guess, you know, they hear these different things in the industry and they think that the market is just going to have major issues and it's never going to come back. And they're fearful and they jump out at the wrong time. I'm going to tell you, if the market has already gone down, it's probably the wrong time to move out, right? You want to try and move out before the market goes down because, again, you want to sell high, not sell on a low side of things. So fear has really been a challenge recently, especially through this whole COVID situation of trying to figure out, you know, are people going to stay in? Are they going to stay out? What's going to happen with that? And unfortunately, a lot of people that I'm seeing have jumped out of the market and then have not gotten back in because of their fear. And they have actually missed a lot of upward movement. We'll talk about that here in a second. The black swan is the last of the 5 events. Black swans are situations and times where you know, things of a major impact will happen here. Like, let me give you an example. Like back in 1939, you had German invading Poland. We had Pearl Harbor. We had 9/11 attack. We have right now Russia and Ukraine going on. So these are different times in our life when massive destruction or massive things have happened that nobody really knows what the outcome is going to be. And so the black swans will definitely cause a lot of market volatility. They can also cause a lot of opportunity to be able to buy things on sale and be able to move in the right direction. So I'm going to tell you this. When a market actually starts to correct, the biggest thing to understand is that it's normal. We do have times where the market is going to move down and then it's going to come back up and then it's going to move down. They call it like a roller coaster ride, right? Because it's just always all over the place. It's normal. When we take a look at like a forest needs to, within years, burn itself down to rejuvenate and come back. A farmer will a lot of times burn out their crops after they've harvested so that they'll be stronger for the next year. It's the same thing with the market. The market needs to sometimes move backwards and have that volatility so that we can go through and have it grow back and be a little bit stronger. So it's normal. When the market drops, the first thing to do is maintain being calm, right? Just maintain your calmness. That's probably one of the hardest things to do, because I think a lot of times we're wired to where we live in the past and we try to go off of what we've seen in history to what's going to happen in the future, right? Just like those technical investors do. And so that's how our brains are kind of programmed. So we have to really work on maintaining being calm. Next, the 2 things to really remember, and I'll start at the bottom, is that you're in this for the long haul, right? So we hear a lot of times, I don't have 10 years to wait for the market to come back. Well, if you don't have 10 years to wait for the market to come back, then maybe you should not be in that portion of the market. There's different levels of the market that are not going to move as much as others are going to, which means being more aggressive than being more conservative. So if you don't have the 10 years, got it. But otherwise, you're in it for the long haul if you're going through and being aggressive, or you're going to see a lot of market volatility. The second is we always want to remember to buy low and sell high. We always want to buy when things are on sale. So volatility is really good for us if we're trying to go through and buy because things are on sale. They're down at maybe their lowest point. Maybe you might buy in and they still go down a little bit. That's understandable, because on the reverse side, you should sell them realistically before they completely peak, right? So as a holding is going up to its top and it peaks and it starts to decline, a lot of people will start to sell it off as it starts to decline. That's a theory, and it's not bad, because how do we know when it has completely peaked, right? So a lot of times in our situation, we like to sell before it actually peaks, even though we know we're going to miss a little bit of that growth, but we also like to go through and buy in sometimes before it's actually hit rock bottom. So that's just how we do things, but always buy low, sell high. And I think the biggest thing to remember is that whatever circumstances happen in life, it will pass. It really will pass. Everything has always passed. That's what progress is all about, and in moving forward. And let's talk about what ended up happening in March of 2020. when COVID actually hit us the hardest here in the US, and we decided to go through and shut the country down. Now, there was a lot of reports about it going through and shutting down. So if it was a case where you had decided to maybe sell off your holdings before they closed the country, sat in cash during the time that the country was closed, maybe looked at what was going to be the up and coming new eras of volatility, as far as who's going to be making money from the volatility, and then jump back in, thumbs up. That's exactly what needed to be done, because you had a little bit of heads up warning of what was going on, right? But hindsight investing is always the easiest thing to talk about. It's really difficult when we're living in the moment to stay calm and try to have a level head to read what's really truly happening. But let's take a look at this. A lot of people went through and were doing pretty decent. And then as March approached and we went to shut down and the market went down, a lot of people sold out at the lowest point. And then they never got back in. They didn't come back into the game. And that's a real challenge, because they didn't then receive the upward movement of the markets. We have a lot of people that jumped back in sometime really in like 2021. And even though they had some growth through 2021, they still missed a very big chunk of this performance in this period of time here. So if you're going to jump out, you need to know basically when to jump back in. That's what I'm saying. It's always hard to do two things of timing it for out and timing it for in. So instead, maybe just stay in for the long haul, right? So if the market dropped down, the market then recovered, the market then went beyond where it was and actually had a lot of record highs during that period of time. So those people who were in the entire time actually came out better off and above. Okay, so you say, get it, I'm still worried though. Well, what you could go through and do if you're concerned about where we're at right now within the current times of the market volatility, I would recommend to take a look at where your portfolio started out and where it is today. If it has actually grown and you have growth in that portfolio, be careful with taxes, but maybe go through and pull off the gains at this time. Leave the original deposit in, let it continue to work for you so you don't miss anything, but maybe pull off those gains. Understand this, your value of your account is not worth anything until the day you sell it. So it always gets me when people go, oh, I lost $20,000 today. Really, you sold today and lost that? Well, no, it's just the markets. No, you didn't lose it then. Okay, just like people go, I gained $20,000 today. It's the greatest day. Really, did you sell it today and pull that off the table? Well, no, it's just the market did well. Okay, you didn't lose, you didn't make anything until the day you sell it. So if you take a look at where you're at right now and you have gains, maybe pull those gains off. Now would be a pretty decent time to pull those gains off, sit on them until you feel the market is at the lowest. I think we're still going to be going down just a little bit from here, but sit till you feel it's down at the lowest, then use those gains to buy back in, buying those shares on sale, and then ride that thing as it comes back into a very, very strong bull market, okay? That's kind of, but if you take a look at your holdings and you're down and you had no profit, do not make a move. My suggestion would be just sit tight. You don't want to make a move after the correction has already happened. Then it's funny they call it a correction as the market goes down. That's a correction. I would think it should be a correction as it goes up. But the situation is, don't sell off on a low point, because we don't want to sell low. If we sell low and then we wait for it to come back into a bear market, now we're buying high. That's just the reverse of what we're trying to say. Always say low and sell high, okay? Worrying is understandable though, and this is kind of what I think it looks like. We get into investing and the market happens to be moving up and you think, wow, man, this is the greatest thing. I am so smart. And then all of a sudden the market goes down and you go, how could I have been so wrong to have chosen the holdings that I went into? And then it starts to recover back and you're like, okay. But then we go through that roller coaster ride. It goes down, it goes up, it goes down, it goes up, it goes down. And that's when fear starts to set in. And you have to just maintain calm, set back, take a breath, and remember it will pass. Don't know the time frame, but it will pass. And honestly, when the market is sitting at this point, if you have more money, man, that's the time to get in. That is the time to fight all of your natural feelings and buy, because it once again is on sale. So you can say, well, maybe I should still go through and take a look and change my investments. If I don't have growth right now, I don't have anything I can pull off to buy when the market's down and everything is sitting kind of down right now, maybe I should change my investment strategies. maybe you should. Maybe you should sit down and take a look at where you're at, and maybe you should be able to diversify a little bit better. I'm going to show you this chart, which is showing how diversification can work. The white squares here is diversified holdings. And the nice thing about the white squares, if you look, they kind of stay right here in the middle. Now, this is from 2002 to 2021, actual real sectors of the market and what has happened during that time frame. And notice how these white sectors don't hit the top or second top line. They're not the best performers. They're also not on the bottom two lines. They're not the worst performers through any of these years. They have been diversified and are just steadily staying along that haul. You know, we talk about the rabbit and the tortoise. These are the tortoise. They are just maintaining and moving along. Yes, they have some upwards and downward times within those years, right? My parents used to own an ice cream business. And I'll say that with the ice cream business, there was different days of the year that were busier than other days, right? You can probably imagine that during the summer, it was much busier than during the winter. And as it got towards the holidays, people were buying different types of gifts, as like cakes and things of that nature, and it was much busier. But there was not a point to where every single day of the year, their business continued to go up, 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 up. There was not a single period of time where it just went up continuous every single year. No, it had up days, it had down days, it had up years, it had down years. That is the market. That is natural. Okay, so you can't expect to open up your statement every single time and see positive growth. Even if you're putting money in, you're buying more shares, you still may see your value be less this next round than what it was last month, and you put money in. And that again is where you got to sit back, take a breath and go, you know what? There's cycles, it's going to move up, it's going to move down. And if your statement is reading low, maybe you should put even more money in because it's on sale, right? I hope I'm pounding that home hard enough. But let's take a look here, because these are the 11 sectors that make up the stock market. So every single company that trades on the public stock exchange has to fall into one of these sectors. So let's just pick this light purple just for fun. Look where light purple is. Let's say you started in 2001 and you went into that, and all of a sudden, man, 2002, 2003, 2004, 2005, you're like, yes, I am amazing. I picked an incredible winner. And then every good thing must come to an end. It starts to fall, and then it falls even more, but then it jumps back up, and then it falls all the way down to it hits the bottom line a couple of times. It never hits the top line again, just the bottom. Okay, let's pick a different color. Whatever color you wish to go through and choose, follow it through on this chart, and you'll see that they're up, they're down, they're all over the place. A lot of them have hit the top lines, a lot of them have hit the bottom lines. Stay diversified. So you're right, maybe it is time for you to take a look and maybe change some of those investment strategies so you can be a little bit more diversified. And understand, if you sell a holding that's down right now and you buy another holding that's down, that's okay in my book. If you sell a holding that's up and you buy another holding that's up, that's okay in my book, because you're just kind of going across the board if you think there's going to be different type of movement. I'm going to finish out kind of with this, because we're talking about the market today. We're talking about investments. But I think for you to deal with volatility and to be able to remain calm and stay is to have a really good plan. And I think you need to take a look and make sure that your income is strong enough that a lot of times you're not really relying upon these investments to handle your income. So you need to be into investments that are going to give you some type of a guaranteed income to cover your expenses, right? Then from there, make sure that you're not overpaying anything in any unnecessary taxes. These two areas right here could help you decide how to actually invest, whether you should be more aggressive or more conservative based on these two answers. And if you do those three things, you lead into longevity. None of us want to run out of money before we run out of time, right? We don't want to lose our independence. And I'm sure most of you would love to leave money to the ones that you love. And so estate planning is always important, to not go through and jump into probate or have other unofficial taxes that you didn't need to pay when you do pass away, and leave those to your loved ones. And this circle just continues to go around and around and around. If you have not had anybody that sat down and actually gone through this with you, you could always go through and check with us if you'd like. We're here to help you understand where you're at and where you're trying to go. I'm not saying that you need to become a client of ours in any way, shape, or form. It's just, if you want to have somebody to chat with, you want to go through and maybe see if you're doing things good, or if there's ways that maybe you could tweak a little bit and get a little bit more out of what you're doing, or if you're just trying to understand one of those 5 different sectors that I just talked about, you can always give us a call. I really hope that this has been helpful. And I thank you so much for following. Listen, you can go through and check out some of the other videos that talk on these same type of topics, but hit in a little bit different areas. Thank you.